And welcome to another Brick by Brick episode presented by Parvis. Today, our focus is the Bluestar Flagship Fund 2. My name is Michael Biscoe, and I'm a dealing representative with Parvis. Thank you for taking the time today to join us for a look at the next generation of private capital investing. Before we get started, we need to do a quick disclaimer. This content is not intended to provide and should not be relied on for investment, tax, legal, or accounting advice. Nothing in any presentation shall be construed as a recommendation or offered to sell or solicitation of an offer to buy any securities. For over 40 years, the Bluestar team has successfully operated as a family office, creating value by identifying, acquiring, and growing assets that others simply overlook with a proprietary deal flow. As you'll see today, they have a proven, repeatable playbook that has allowed them to enter fragmented markets early, consolidate businesses, and deliver exceptional annualized returns, well over 30% across sectors like construction, manufacturing, and software. Today, they are applying that same successful model to the professional and financial services industry, consolidating legal, accounting, wealth, and insurance firms into a powerful integrated service platform. This unique structure allows them to do more than just invest for growth. It provides comprehensive, client-centric service offerings that help investors like you see the value beyond potential returns, specifically through the structural benefits and tax efficiencies that come with this comprehensive approach. During the course of today's webinar, we will walk you through their history, break down exactly how they invest, and explain why this particular opportunity to invest along Bluestar is being presented today. We believe this is a unique window before the next wave of capital discovers this market. And with that, I'm delighted to introduce to you the CEO of Bluestar Equities, Noah Murad. Noah?
Hi, Michael. It's nice to talk to you again.
Maybe just a really quick thing is, who is Parvis? Parvis is a technology-driven alternative investing platform, exempt market dealer, bringing institutional grade deals to the public through private capital. With that, Noah, I'll let you take off here.
Okay, great. So today, I just thought, since we have this is our second brick by brick, we went through a lot of detail in the first one, and encourage anybody who missed it to go back and check it out. Today, I thought what we would talk about is high level. If we want to accomplish, I guess, three things today, it's to get to know us, Bluestar, understand how we're investing, and then mainly why today, why have we created funds today. So if that's good, we will get started with that. So high level, who we are. So we're a family office with a 40-year investing history. We focus on buying, building, and growing assets that are overlooked by others. And what we mean by that is they're, either out of favor or just not being paid attention to at that moment. So here's a quick rundown of our family history timeline. It's hard to capture it all in one slide, but this is high level getting to know us. Business started in 1975. My father left home when he was 16. He started his first business with his cousin, and they sold it a few years later. Around 1980, when he was still in school, he started to get jobs working with the banks that were, or the investment banks that were working as intermediaries for his first business that he had sold. And then he got into a more solid role with those firms. He served as a special financial officer for the banks for workouts and other specialty finance transactions during that period of time. He founded the practice, which still exists today, LRP Solutions, which was the consulting practice and workout and finance advisory firm, and also Bridge Capital Corp, which is a private lending fund, a private debt fund that existed up until the mid-2000s. During that period of time, the firm grew to oversee more than $1 billion in assets over that entire period. Between 2000 and 2010, Capital became one of the largest private debt lending firms in the country. It wound down after 25 years, and the annual returns were 16% per year to investors. I joined the firm in 2008 and essentially founded with my father what is now known as Bluestar Equity. It's our family investment practice. Jacob, my brother, joined as general counsel, and my older brother joined as our CTO and marketing director. During the period of time from 2010 to today, we've completed over 100 acquisitions in various industries, divestitures, and exits. 2024 to today, we launched formally the Bluestar Flagship Funds, inviting our clients to invest alongside with us with full offering memorandum and accredited investor offerings. And over this period of time, the exits, the transaction values that we've generated for ourselves, as well as some friends and family that came in, has totaled over $250 million. So essentially, what we're trying to do when we are looking at transactions is differentiating ourselves from other firms. Today, there's a lot of capital in the market. There's a lot of private equity companies that are investing in businesses. So the key differentiator that we've always had was that we create our own deal flow. We don't go through auctions or brokered processes. We originate all of our opportunities ourselves. This started with LRP Solutions. When my father started the practice, we would see 600 opportunities per year, and we would either take on mandates or invest in businesses across the board. There'd be about 50 different opportunities we would take on and originate during that period of time. And as I'll show you, this has expanded as we've added in different professional services.
So where do most of the deal flow happen? Are they through clients that you're engaged with? Is it your network? Where are the majority of the deals that you choose? Where do they come from?
They're typically coming in through referrals and existing clients or clients that we've had in the past. And then what happens is that we will typically meet a lot of clients that are in the same industry, and we'll get a sense of what's going on in that particular industry. And then we'll start to see where there's opportunities for us to add value. And this is pretty much what I just said. We start to see consolidation patterns through the multiple hundreds of opportunities we see a year. And we look for those types of patterns, particularly because that's what we do. We get involved in an industry that we want to see a lot of owners that are shifting their essentially shifting the assets to the next generation and don't necessarily have children or friends or contacts to sell it to. So going into detail in our playbook, the way we look at investing on the private business side is we're looking for fragmented industries. We're finding owners that are ready to or approaching retirement. And then we offer those owners a succession plan. We take over the business. We operationally improve the business through technology, staff, best practices that we know, or economies of scale. And then we grow the business through acquisition. And as part of the global portfolio or offsetting risk, we also invest in real estate and maintain a healthy liquidity buffer. So that way we can weather any sort of ups and downs of the business as it's going through its growth. And then we have several examples that I wanted to show today of times where we've done that within the last 10 years. So 2010, which was sort of one of the main areas we got in front of early, was construction and HVAC services. So LRP Solutions put us in front of a lot of construction and HVAC owners. So this would be insulation, heating, cooling, supplementary services for, let's say, environmental audits, things like that. So we saw a lot of fragmentation and aging owners with children who didn't want to go into the trades. And we also saw that these owners were looking for a retirement plan. So starting in 2010, we already knew a lot of these businesses. We knew their owners. we had relationships with them, and in some cases, we're providing them with consulting services. We acquired 11 construction and service companies over the next 7 years. Most selling owners also happen to own their real estate. So what we would do is we purchase the office property that they were operating out of, and we selectively purchased the properties that we thought had the highest liquidity, and we bought those as part of the portfolio. So, like we saw often, as after we completed our roll up, we started to see a lot of private equity and other types of strategic buyers coming into the industry. So here's some just examples of some of the research that was being done. You had Forbes, Capstone, these types of companies that were all covering the movement of private capital into these industries. And as valuations were up during that time, we don't really look for explanations as to why. We just look at the opportunity to exit. We started exiting all of our construction positions, and we grossed over $65 million in exit value proceeds, which includes the real estate properties which were sold to different buyers. So this is a very typical situation where we got in early and then were able to exit when we saw the valuations increasing. Again, plastics manufacturing, what we saw in 2013, again, a fragmented niche industry supplying specialty plastic products across North America. So we saw an industry that was very much focused on either very big contracts and large customers, like providing recycling containers to government, or there were niche products that were being made as ancillary products like small parts, small containers, these types of industries that were very much disparate. So what we did in 2013, we identified 3 of these plastic manufacturing companies, one of which was publicly traded and was manufacturing biodegradable plastic materials. Again, after we made our investments, we started to apply our strategy of operational improvements and growth through acquisition. By 2018 to 2022, we saw a lot of consolidation in the plastics industry, a lot of capital moving towards there. So we decided to exit again in 2021. Our biggest return was on the publicly traded entity, which was a very healthy return for ourselves and our investors. Okay, software and SaaS, another example. What we saw in 2012, that there was a lot of need on the small and medium-sized enterprises for automation and payment technology. We also had a lot of history in Bridge Capital, having funded an independent debit software or payment processing company and selling it off to US Bank. So we had expertise in the industry, and we saw a lot of different companies with a lot of different software needs. So what we did was we invested in payment automation, workflow systems, and a credit scoring companies, and we put them together, and we were able to essentially provide credit scoring and payment automation for the construction and small business industry here in Canada. Once again, we saw late 2020 teens years, SaaS became one of private equity's biggest categories. And in fact, there were whole private equity funds being created just to buy software as a service companies. So we took our company public again in 2021, and we grossed over $32 million on that exit for ourselves and our investors. So those were 3 examples of industries which we applied our playbook. We got involved with owners that we already knew, and in verticals that we already understood. We put them together when we saw that there was a lot of discussions amongst owners, and then we exited when the market was a little bit more favorable. Along the way, we saw real estate. So in each vertical we get into, many of the retiring owners own the properties that they operate out of. So when you're negotiating a deal with real estate owners that are also the business owners, you have a unique opportunity to negotiate favorable terms on the real estate. So whether that's payments over time to offset, let's say, liquidity needs that you would normally need to have when you're buying large office properties, or you can adjust the values of the real estate by decreasing the real estate value relative to the business and maybe increasing the business value because the owner he has a particular tax plan. So you can work with the seller to adjust values based on what works for them. And what ends up happening is you can buy a bunch of properties that have very unique values, and you can package them up together in a particular portfolio, or you can leave them separately. So what we did is we had a portfolio of properties it grew to probably 13 different properties over that period of time that we were able to exit to different buyers along the way. In some cases, they were real estate investors, and in some cases, they were just other, investment partnerships that wanted to accumulate office property. So these were all part of the businesses that we bought, and we have invested also in some separate developments, but typically the best opportunities we see are in these as part of these purchasing the businesses that we would normally buy in the private equity portfolio. Okay, so that takes us to where we are today. Where we see the current trend today is professional and financial services. So we're seeing the same trend in legal, accounting, tax, insurance firms, as well as wealth management and financial services firms. We're seeing the same characteristics. The industries are very fragmented, but they are operated by stable, retiring owners. They are very profitable, and they're typically run by the initial person who founded the practice, or people who founded the practice. There's also a major upside in upgrading technology within these older firms, and also incorporating artificial intelligence in the processing of the actual delivery of the service. So most of the time when we're buying the retiring owner's practice, it's very much run on paper. And the opportunity to come in and just professionalize it with practice management softwares, refining their marketing plans, and also making sure that the throughput or the communication amongst staff is smoother by using any of the basic communication tools that we have through practice management softwares. Those, you're getting a huge lift in terms of the efficiency of how many clients can be managed by one professional. So this is going on regularly. There's certain areas of, particularly in Canada, that are way behind in terms of how they run their practice day to day, and there's huge upside in being able to put that together. So one of the questions that I know Michael's asked me many times is what are we actually investing in today? What are the LPs investing in? So the fund, the Flagship Fund, our core assets are essentially made up of 4 categories today. And I'd imagine that we'll add more core assets as we go. But if you are looking at this today, this is what we're primarily focused on. The first is what we call Bluestar Professional Services. So in professional services, following our premise, we've already rolled up over 14 legal, accounting, wealth, and insurance firms. We've grown to employ a team of over 100 people across Canada and the Southeast US. So what we do in Bluestar Professional Services is we're buying, we're fixing, and we're integrating practices from retiring lawyers, accountants, insurance, and wealth managers. So all what we do is we put them all together. We centralize the client base and market to those clients under one brand. And then we're able to offer a client for a legal firm multiple services across multiple disciplines. And currently, we're doing that for 30,000 clients annually. In the fund, we have a robust pipeline of deals that we're looking at any given time to acquire and integrate. This is, again, something that we've done many times over the last 10 years in multiple industries. And in Bluestar Professional Services alone, we've already done over a dozen times. So really, it's a rinse and repeat formula. We meet the owner, we negotiate the purchase price, we purchase, and then we integrate into our regular servicing, and then we're able to cross-sell the clients across multiple disciplines. And this is something we can do. We see no end of this of the demand for this, owners wanting to retire anytime soon. We think we can grow this as far as we can see right now. It probably has the most potential we've seen of any roll up that we've had, because you're getting new entrants into the market at any time. It's very easy to just, hang up a shingle and start a consulting practice. And we're finding a lot of people that are a few years into it and still want to sell their practice. So there's deals coming from all over the place. And as far as we know, we're the only ones that are buying and rolling up legal and accounting, as well as insurance and wealth in the same umbrella. So that's the first. And Michael, would you mind going back just one slide? Thank you. So, and I don't know if you have any questions about that in particular, if I covered everything, but.
No, that's great. I think if anything, there's a couple things that I'd like to ask and then also offer. I mean,
Sure.
when you're rolling up all of these services, sometimes the better return might be creating efficiencies within someone's life that they may not know is there, whether it be tax efficiencies, whichever which way that can represent where someone isn't seeing something in their situation. So, while we're looking at very strong returns here, which we haven't covered, but what the real opportunity for some will be is getting folded into all the services that you have, and it's all under one roof, working together, going in the same direction, where you're not having to manage this anymore yourself. This is all being managed by one entity or one umbrella. So that's it's a big point on my side. And then the other question really is, and I know the answer to this, but I want to hear your response, is, how much debt are you utilizing in order to buy some of these businesses? I know real estate's a lot different than what the current approach is, but that's one of the most comfortable aspects of what you're doing here is the lack of debt that you're engaging.
Yeah, right. So, I mean, in terms of how we're purchasing these firms, we're not using Bluestar Professional Services is not using any debt. So what's happening is that the fund is coming in, and we're usually, if you take, for example, $1 million purchase price, our typical deal would have something between 40 and 50% down in cash, which would be equity. Then there is an earnout component, or there'll be a holdback to make sure that all the clients are being transferred over properly, and so that the seller has skin in the game for us to integrate the business. So what you have is basically a very low leverage, or if you want to count the earnout obligations as some form of leverage, but there's no bank debt, and there's no basically Bluestar or the fund is sitting in the first position on everything, and we're also, I should mention, since we're discussing acquisition terms, we also are buying very cheaply, right? Because you're buying firms that there's a lot of demand for, right? So we're getting in, and we also have the ability to put together deals very quickly. So you have the ability to move quickly. You're not looking for third-party approvals or anything like that when you're buying, which all sellers really like. So you're coming in with that type of offer, you get very good terms, which also reduces even the total invested amount, right? In the deal.
And then what's your average cycle from purchase to exit?
For all of these different firms?
Correct. Yes.
Well, actually, we have another slide that talks about exiting, so I'll get to that in a minute. So I'll go to the second one. So our second core asset is called Hair Payments, which is another amalgamation of payment software assets. Again, we had done this previously. We continue to see a completely disparate, fragmented industry in this sense, with different regulations changing all the time and different compliance restrictions all the time. So we put together several of these software assets, and this happened over the course of a couple of years, and we have recently announced the exit to a publicly traded firm, which we are supposed to close by the first quarter of next year. And what our firm does is we offer gift, loyalty, and other corporate marketing programs to corporate clients. So they can use reward systems. It's a very robust system, and we expect to be able to grow the business even after the exit. We'll still hold a position inside the publicly traded firm and continue to grow the value of the stock. The third one is Parvis Invest, which Michael, obviously you know well. It's a publicly traded fintech platform that raises and processes capital for the exempt market. We're, again, a large shareholder in the firm and have backed management in what we think is going to be a very, very successful expansion across Canada, offering a much needed service to business issuers across the country. And then the last one, of course, is the same real estate opportunities that result opportunistically from owners looking to sell their businesses. We already have a pipeline of several properties that we can purchase. We're not under the gun to purchase them. We have typically a right of first refusal. So these are all things that these are all assets that we will add into our portfolio, again, to offset any sort of volatility as it relates to operating businesses. Okay, so again, just to be very clear, what we are using the capital for as we expand the Flagship Fund is to be funding acquisitions for Bluestar Professional Services and to continue to expand the fund's ownership of that business, to purchase additional shares in both Parvis Invest and in Hair Payments if it's needed. And if we will do that if there is an accretive value for us to do that in both those businesses, to purchase those real estate properties, and to purchase other service businesses in other categories, which I'll get into. I should mention that the real estate properties, we would use leverage. We would use first mortgages from banks, but nothing that would be out of the quote unquote ordinary of what you would see in the normal market. Okay, how we will exit. So this was getting to what you were saying, Michael, in terms of how long. So our fund life cycle is essentially 6 years with an option to get out after 3 years. So investors do have the option of cashing out after 3 years. We have always created some sort of refinance or some sort of exit within the 3-year time frame. And it's something that we've always done since the Bridge Capital days, and we expect to continue to do. That being said, if investors are excited about the growth or as excited as we are, they'll stay for the 6 years. And we are very confident that the returns will be high enough to warrant staying the 6 years. I'll put it to you like that. So in terms of our plan of what we would have in the fund at that period of time, we would have Bluestar Professional Services exiting to either a strategic firm, which I've listed some of the major multidiscipline consulting firms. KPMG has a division called KPMG Law, which is a US-based division. I think that Deloitte and EY have also discussed partnerships with law firms in some way. They've also, of course, had the accounting and the tax planning and this type of thing since inception. And the key thing is that we know that these larger firms are going to be looking for an answer to capturing a larger share of client wallet, and that's why they've made their way into legal services. And I think that will be a very, very, I shouldn't say easy, but obvious exit potential for us with Bluestar Professional Services. The other two options we have are very standard for us to do. Either we exit to another fund, which could be our third Bluestar fund, or another private equity firm, or we can take the company public. These are all things that we've done in the examples that I've mentioned in this presentation. Number two is Hair Payments. We've already made the exit, so now it's just a question of taking the, getting the best value out of the exit and not selling too early. But as far as the fund investors are concerned, we've already exited. Parvis Invest, there's a very strong possibility that we can build a very nice position in the company and just come off of our shares. That's probably the most likely, or down the road, if Parvis is approached by another strategic asset manager or something like that, there's a possibility that will happen, and the board might want to go ahead with that type of transaction. So that would be another way we would exit. And then, of course, with real estate, we would sell the properties off either one by one or to another investment partnership, depending on what extracts the most value. So I think the main point here, Michael, is that as soon as we get into something, we already know how we're going to exit it. We even know what size is going to be attractive to buyers. Okay, so again, I want to go through what we've done here just recently with hair payments, really just as a summary to show you that our methodology continues to work even as we go through the markets today. So we acquired and integrated multiple payment processing software platforms into hair payments. Our tech team, we have an in-house tech team led by my older brother, Aaron. They cleaned up the major issues with the software, which had to do again with compliance and a lot of regulatory hurdles and privacy and these types of things, which were changing all the time. We cleaned all of that up, made sure that it operated properly. We improved the vendor and customer partnerships and the key stakeholder partnerships, and improved the overall operations of the company. Then it was an attractive acquisition to a publicly traded firm, and we made the deal to sell to them. And this is just another example of our model where we see the trend happening amongst various clients or various businesses that we're seeing through either LRP solutions, our legal firms, our insurance and wealth firms. We do a lot of research, we talk to owners, we talk to everybody, and then we can see the opportunity, we consolidate, and then we exit. So again, this whole thing about our main advantage on deal flow, this whole thing is like a flywheel. What happens is we acquire a firm, let's say it is a law firm or an accounting firm. When you acquire the firm, you acquire a giant client base, usually of at least a few hundred potential clients, if not thousands of clients. The clients need services. In some cases, a legal client needs an accounting, or they need corporate advisory services like LRP Solutions provides. We help them, and then as we help them, we get to know the industries, and we start to find investment opportunities, maybe from some of those clients who want to sell their business. So we acquire the business, and then we gain a new client base. Again, whether it's the law firm clients, or we acquire a bunch of corporate clients as a part of that new business we just bought that need new legal help. So they get put into the legal services if they want. And then the cycle continues to compound as we grow. So the more people we know, the more research we can do, the better the deals, the better the fund performance. And then just high level, I mean, these are the overall sections we're looking at investing in. We see also fragmentation in healthcare practices and software related to healthcare. So there's a lot of opportunities there. We're going to continue to see consolidation there. We've been looking for a foothold in that industry in some way. Of course, that overlaps with software and SaaS, which we have experience in. Small public companies in the service industry. There's a lot of sort of what they call orphaned public companies that are out there that cannot grow because of their structure. We can get involved in those as well. And of course, professional services. So we're looking at these industries primarily to make our next investments. Okay, so to summarize everything that we talked about, this is what we covered. We have 40 years of creating proprietary deal flow. We have created with our investing a repeatable pattern across multiple industries. We are usually involved in those industries because we are talking to the business owners at the small and mid-sized level. We're usually there before mass amounts of private equity come into that market. And we showed also that there's a unique window to invest today, right, alongside us before that capital comes into the market. And here, I we've just put up the Flagship Fund 2's terms. And to summarize it, if you look at the blue box on the bottom, we pay an annual distribution of 8%. So unlike other private equity firms who are locking you up for 7 years or maybe 5 years, we pay regular distributions of 8% annually. Investors receive it as 2% per quarter. And then there's another 8% preferred return that's paid to total 16% annually. And then on top of that, there's a profit split after a performance fee of up to 50% of the net profits after the performance fee. So our annual target return is 20%. And again, all the way back to the Bridge Capital days, this is something that we have paid. We've paid 16% every year. We've paid more in many years. We're very comfortable with the target of 20%. We feel very confident that we can hit that. So the fund is an OM offering, and we take eligible and accredited investors, and we can do it in registered accounts as well.
So maybe we can just cover a little bit about the structure of the fees and where they are in the capital stack.
Yeah, sure. So we charge a 2% fee on the investor capital, and then we have a 20% performance fee, which is paid over. It's only after the investors get their 8%, and then after that there is that 8% preferred, and then from there we will split the balance 50-50. So I mean, what our fees are actually. There's a couple of points to make on this. Like, our fees are actually pretty standard. I would think that, in fact, even having the preferred rate, we feel very good about that, because no matter what, we have to pay that 8% return before we make any money at all in the performance fee. And we actually, when you do the math, don't make very much until we clear the 16%. So only when we clear the 16 do we really actually make big money. So that really aligns the GP with the LPs. And I should mention, which I didn't earlier on, that our family is invested alongside the LPs. So we own Bluestar Professional Services with you. We have capital invested in the fund. It's around 15%, our target of doing that. So we very much are incented to succeed, and then to succeed really well, because otherwise we won't really make any sort of better win that we would have made if we were just doing some real estate investment or something like that.
Great. I think it's also good to cover that the distributions are essentially represented by the cash and marketable securities aspect of the portfolio. So there's always cash available for those distributions.
Yeah, exactly.
I mean, I think it'd be good to maybe cover a little bit of some historical. We've talked a lot about your successes. Maybe we can just cover how you've dealt with some of the challenges over the years and what the results have been of those challenges.
Yeah, sure. There was a couple of transactions where, I mean, the biggest challenges we've ever had were dealing with people that were not who they said they were when we first got involved in the transaction. And so you can have a deal where you are, you think you're going down one premise, and then the other side sort of changes their mind. And that's not really something that we do, or frankly, even really understand. So typically what will happen in that case is that we will figure out a way to separate from that partner. In some cases, we have had to invest our own money from our family or ourselves to pay for these separations. To give you an example, in some cases we have had to sell something prematurely, let's say an asset, we would sell it prematurely, and we had to pay for all of the fees related to actually selling that, and then made sure that the first money, of course, goes to the investors. So we would have lost money, we as a family would have lost money or some equity that we would have made just to make sure that the separation is somewhat clean and that the investors all got their money first. So I would say that like in transactions that have not gone the way we wanted, we've still made money, but that's like sort of the collective we. If you looked at my family, there's been many times where we didn't.
Thank you, Noah, for taking the time to pull back the curtain of Bluestar equities, and I encourage everyone to be able to engage their dealing representatives to see where this might fit your portfolio. And I hope you guys all have a wonderful day, and look forward to speaking more about Bluestar with you. Have a wonderful day.
Thank you.